Small world.
Amazing. Okay, excellent. So I love this intro. I have the huge pleasure of inviting Dimitry up to the stage. And we're going to do a fireside chat between the two of us. So the first 40 minutes will be he and I basically chatting, and I'll ask him a bunch of questions. We'll go back and forth. And then the last 20 minutes are saved for audience questions. And so we have a Slido that Denise will share throughout. Thank you, Denise. And you can add your questions there. And also engage in chat in the Zoom chat, however you want. But anyway, Dimitry, super psyched to have you. Thank you for being part of the On Deck Climate Tech community and just being a fantastic community member. And I think doing some really pivotal and impactful work in the climate space. And so the first thing that I want to ask is, in lieu of me introing you, the first question will just be, what is your background and how did it converge into this space of working in climate finance gaps?
All right, I'll try to keep this brief because I could probably spend the entire Q&A talking about how I got here, because it's not the typical like Goldman Sachs to whatever trajectory. I've worked in climate, and you could call it impact investing, for over a decade now. I started my career working internationally in emerging markets, advancing energy access, sustainable ag, clean cooking solutions. I lived and worked in Latin America for a while, East Africa, places like South Sudan and Kenya. And I ended up at all places at Facebook, where I led a program to support expanding electrification in emerging markets as a driver of connectivity, and later a driver of people getting on Facebook. And we ended up doing a lot of work in catalytic finance. So we provided capital to folks who were deploying money for solutions in these markets. And we ended up investing about $15 million, and by our estimates, unlocking about $500 million of additional financing into the market, and sort of directly contributing to access to electricity for about 3 million people. And so, and I'm sorry about some of the background noise. I'm in a co-working space and it's usually really quiet, but I think there's some kind of tour going on, but we'll manage. So anyway, I did that for about 3.5 years. And then the team wound down. I ended up transitioning to a different group. I ran some corporate accelerators focused on impact tech, one in India, one in Puerto Rico. And I also helped stand up a credit fund together with Calvert Impact Capital, which provided small loans to women e-commerce entrepreneurs in emerging markets who were trying to build businesses on the Facebook platform. And obviously, like if you're a woman entrepreneur in, I don't know, Indonesia, your access to capital is basically zero. And so we were trying to solve that. It was a $10 million fund. I ended up leaving Facebook in early 2020. I had aspirations of starting a climate tech venture fund, but I had maybe the worst timing in the world, because 2 months later, the economy sort of collapsed and COVID like really started. And so I ended up joining this group called Enduring Ventures, which is part holding company that does sort of M&A portfolio kind of long-term holding, and then part venture studio. I joined as an operating partner, did some M&A work, and ran one of the portfolio businesses for about a year. And I also helped incubate our first company in the venture studio, which is also a climate tech business. I actually still sit on the board of that. It's a lower carbon backed kind of emerging market climate business. And about a little over a year ago, I had the opportunity to like figure out what to do next. The team encouraged me to start a new business out of the venture studio, and the climate finance, the gap of capital that we need to solve climate change is it is hard for most people to wrap their heads around. So for context, like we need about 5 trillion a year in investment to get us to 2 degrees C, which is like sort of the baseline for survival. And last year, I think there was about 650 to 700 billion invested in climate across all the different types of capital. So like 1/8 of the way there. And one of the big gaps is credit. It's like access to debt capital for folks to grow their businesses. There's also gaps in equity, there's gaps in project finance, like there's gaps everywhere, but one of the gaps is credit. And so there's been a lot of growth on the venture side, on the late stage growth equity side, on the private equity side, and government investments and corporate spending. There's been basically no growth on the credit side. And so seemed like a good place to play. And that's why we started Enduring Planet in kind of call it May, June of 2021. And so since then, we raised money. We've made a bunch of investments. We're launching a new product. We do lending for climate entrepreneurs. We're starting at the sort of earlier stage of the market, but the vision over the long term is to build a platform that offers climate entrepreneurs founder-friendly debt at any stage of their business, sort of from inception to IPO. So that's what we're going to build. We're going to deploy an insane amount of capital over the next 5 years. But we can talk about how we invest, why we think credit is an important tool in this ecosystem, I think, throughout this call.
Amazing. Thank you for that. And so I wrote down a couple of things that you said that I think are keywords and key things to keep in mind. One is unlocking capital, and I think unlocking impact, right? And so this thesis that if you can sort of push this lever up of capital, then the lever of impact is just, exponential after that. And then you talked about how we're basically spending an eighth of how much we need to spend in order to get to 2 degrees Celsius, which is baseline survival, is how you put it. And then talked about catalytic finance and microfinance in some ways, and all these different terms. And so what I want to do now is, I think our audience is both split between entrepreneurs and people who are just generally interested in maybe climate finance innovation. So taking a bit of a step back and thinking about what is, this is a big question. So you can sort of simplify it, but what is the climate finance landscape today? Who are the players? How is it organized?
Yeah.
And kind of defining some of those key terms that you talk about. So even defining debt versus
Sure. Yeah. So you can think about capital flows in climate as split across a few verticals, right? There's the money that's spent by the government on sort of government initiatives. There's the money spent by corporations to decarbonize themselves. There's the money spent by consumers to invest in their own, emissions profiles. And then there's the money flows that go from some pool of investment capital, and we can talk about what those pools are, to players to do work, right? So there's project finance for private project development. There's corporate finance where there's capital flowing into companies that then do stuff in climate. There's consumer finance where banks will provide loans to people to buy heat pumps, right? There's a lot of money flow that's required for us to achieve decarbonization objectives, because unfortunately we live in a capitalist society and you can't do capitalism without money, right? That's how it works. And so we could spend many, many hours talking about all the different flavors. If people want to learn more about this, I encourage you to look at, there's a annual climate finance report that Climate Policy Institute does, looking at all the flows of capital into the space, and they do sort of a tally and they show where it comes from and where it goes. And I think that's a really useful way to picture this. And I don't know if somebody can drop a link. I can drop a link sometime later in the conversation into the chat, but that's a good resource. And our work focuses on corporate finance. And so what is corporate finance, right? This is equity or debt investment or a grant capital flows into a company, into the company itself to do work. This isn't investment into projects, right? So project investment is separate. There might be companies doing projects, but when they raise money into a project, that money is just tied to that individual thing, right? Corporate finance, you're investing in the entity that's doing the work. And that can be grant funding, it can be debt funding, or it can be equity funding. That equity funding is usually venture until you get to a certain stage where it's not venture, it's private equity, right? And the debt can have lots of different flavors. You can just do a loan to the company that's unsecured. It's here's money, you pay me back, right? You can do invoice financing. So they have an invoice that's going to get paid. It's going to take a while for it to get paid. you can lend against that invoice. You do inventory finance, PO finance, receivables finance, revenue-based finance. There's like basically debt can be shaped however you want. The key is that you're not taking an equity stake in the business as part of that loan, unless you're a venture debt lender, in which case you usually have a little like equity kicker as part of your structure. And then grants are grants, right? Grants can come from private foundations, public foundations, corporate foundations, the government. It's like lots of different grant flows into the market. So I think the thing to really understand is that like, there is no limit to how money can be structured to achieve a commercial objective. Anybody who tells you otherwise is just wrong. But a lot of people think that way because the way that finance has worked historically is around very rigid buckets of what money can and should do and how it works. And I think over the last, like, I don't know, 2-3 decades, we've seen a lot of expansion of how people think about capital. And some of it leads down very dark and terrible places. So like a lot of the sort of consumer predatory lending ecosystem has emerged over this time. But at the same time, there's a lot of really innovative credit instruments that have led to a dramatic expansion of sort of capital flows into otherwise unserved or underserved areas. One good example is like e-commerce lending. 10 years ago, you wanted a loan as an e-commerce business. Today, you have like 50 options, and most of them won't make you put your house up as collateral. They won't require like really complicated stuff. It's expensive money, but it's like an expensive place to lend because e-commerce businesses are born and die like every day. And so just like that, climate has presented a really interesting challenge for the capital market because there's a regulatory component to climate. I would argue there actually isn't, but lots of people think there is. There's like weird timelines to profitability. There's weird revenue models where people are like, they're a software business, but they're also a hardware business, but they're also a services business. There's slightly different like payment horizons, you know, like in traditional software, you get paid monthly. In climate, people like you'll sell software to a utility and they'll pay for 3 years upfront, which is great in some cases. But in other cases, you're like, well, crap, I have a customer who paid me 3 years upfront. And like for the next 2.5 years, I have no money coming from them at all. And so like it creates cash management issues. There's like all sorts of stuff. And so it's a space that's deeply underserved. And there's an opportunity, there's a lot of opportunity for like really cool innovation to support this market. I'll stop.
No, that's fantastic. And so just a reminder for everyone here, we're going to stop this like fireside chat one-on-one interview in about 23 minutes. So keep dropping questions in the slider that Denise just dropped. And we're probably going to spend, Dimitry, a couple more minutes just on like the larger landscape and then dig into enduring plan and also just like how you think entrepreneurs should be thinking about organizing all of their options, right? And what the best options might be for different entrepreneurs. So one question that I think, or something that you said that I think is really important is like, if someone says, you know, a new sort of innovation in climate finance can't work, or like something can't work in climate finance, you just say, fuck off. Like it probably already has been innovated on, or like there are new asset classes that have been created, you know, over time, and all of this is created by humans. And so I totally agree, and I'm really interested in this space of how do we innovate in the finance space to make sense for where the climate space is today, where it's going to be tomorrow, and also just like, again, unlock capital and unlock a shit ton of impact, hopefully. And so I think we're on the same page there. And then one thing that I just wanted to drill into, so I think you were talking around it, but essentially there's like another way to think about the finance space is just what's dilutive and what's non-dilutive. So would you just mind defining that piece just as another sort of way to think about it?
Sure. So at its core, dilution is what occurs when an investor trades you money for a part of your business. Mm-hmm. So typically the things that are dilutive are like venture investment, angel investment, you know, whatever. And then sometimes instruments can be sort of quasi-dilutive, which is so basically venture debt. Like I'm going to lend you money, but I have a warrant or I have some kind of equity kicker, or some instrument where either at the start or at the end of the loan, I get a piece of the business as well. And I think the thing to remember about all of these different capital products, and this is true of debt, equity, et cetera, is that all of the terms work together. And as an entrepreneur, if you're raising money, you should never make a decision based on like one term. So a lot of folks, they'll like really focus on the cost of money, which is fine. I think it's a good way to like apples to apples compare money. But the problem is if you compare a dilutive instrument like venture with debt, the costs are actually pretty difficult to compare. So I'll give you an example, right? So venture money, you raise it, you don't pay anyone until there's an exit. So in some ways it's free, right? Like, cool, I don't have to pay you anything. And if I fail, it's like zero. This is awesome, right? The problem is if you're raising venture money, like through, let's say Series A, the effective return on that capital, if you are successful, is somewhere around like a 50 to 100% IRR. It is the most expensive money you will ever take. Really, probably through Series B. And it also kind of depends on like if you raise later stage money and then you exit immediately, it's like it's really expensive money, right? And so if you compare it to debt, all debt will be cheaper. But debt takes money out of your business in real time. And so like you have to think about how do you value those things and how do you build it into like a model, right? And then if you look at non-dilutive capital, there's often lots of terms that work together that influence decision-making. So grants, they're free. Amazing. You should always take a grant. Well, probably not actually, because some grants, the operational headache of administering the grant is much greater than the actual value you get out of the money that you get. And so if you're somebody who's like, hey, I'll give you a $50,000 grant, but I need to talk to you twice a week and you have to do monthly reporting and it's in this format, blah, blah, blah. It's like, I don't want your 50 grand. It's not worth it to me, right? And so like, one of the things that we see a lot in this industry, especially I think in climate, this is like often the case because climate entrepreneurs don't come from like financially savvy roles or jobs or fields. Like people have very rudimentary understanding of the finance landscape and like how to actually compare money. And that's fine. And I'm hopeful like between our work and there's so much good work happening right now to like educate founders in the space around capital. But it's not always as simple as like, oh, I have these two options and like, I'm just going to compare costs and like, that's going to be the right decision. I know I went like way past dilutive, non-dilutive, but.
No, this is the point.
Yeah.
That's the point. And I think when you said like, it's expensive capital, like that's what people mean when they're talking about the cost of capital, right? Whether it's expensive or cheap, but there are different ways that you can think of expensive, right? Like the operating costs that you said. Yeah.
So I think the other thing too is, and this is, I think the sort of the next step of that awareness or understanding or how you navigate this process is like, well, why is it more expensive, right? So for example, you could get, let's say you're trying to raise money and you go to two lenders and they hand you two term sheets. One costs double than the other. The easy answer is like, well, shit, I'll get the cheaper one. Okay, well, if you go one layer deeper, maybe the one that's cheaper also requires a personal guarantee, right? So one is, I don't know, 25%, the other's 12.5. But if you screw up with the 25%, you don't pay them anything. So you just go out of business. But with the 12.5, they take your house. Well, now which one are you going to take? Right? Well, also like, what if one you pay down principal in real time, and in the other one, they want principal at the end? Well, actually, the amount of interest you accrue will look different over the time period. And so you may end up paying actually less money for the one that's more expensive because you get to pay down principal over time and the other one you don't. And so like, this is why I think people should spend some time really getting educated on all the different options. Like if you're going to run a business in this space, the finance landscape is about to get really wild in a good way. And it is the duty of the founder who's raising money to say, okay, what is best for my business? Why do I need the money? What am I going to use it for? What is the impact of repaying or not repaying in real time? What other value do these investors bring to the table, right? Like not every lender, not every VC is the same. Some folks will give you money and fuck away, and other people will show up and they'll be champions for you, which like has a lot of value, even though their money might be more expensive or it might be more complex or it might be more dilutive, like whatever. So I think I just like my like call to action or like, I don't know, advice here is like, money's complex for a reason. And if two people offer you money and they look dramatically different, there's probably a good reason. And generally, trade-offs in cost or dilution come with consequences. And so just keep that in mind as you approach capital markets in this space.
Amazing. I think my key takeaway from this first 20 minutes is it's a complex space. There's so many different instruments, so many different ways to think about cost. One ask, if you haven't created it, is, or if you know that something like this exists, is there like a questionnaire where if I was raising money and I was looking at like a term sheet or something, like, could I be like, okay, like what is the interest? What is the payout? What is the time? Like essentially just a list of questions that I could compare things. And do you know what I'm trying to say?
I love that. Now I like want to build it.
Yeah, let's build it.
So there are, I think there are lots of resources for founders to navigate venture term sheets.
Right, but actually thinking about like different instruments fundamentally.
There's very little that I've seen that's like easily accessible that allows you to like plug in two different sets of terms and get sort of some output that allows you to make the comparison easier. In part, I think I don't know if it's possible to do it really well because a lot of that comes down to your business.
Yeah,
right?
I actually don't want to plug in. I just want to take the 10 questions that you just like spit out. We can start there, just write them down. Because I think so many people, including me, wouldn't think of all those questions. And even just as a starting place.
So, I mean, then yes, there is a resource that does that, which is our Insight series, which we publish once a week. So every Tuesday we put out a piece that looks at like tactical questions around fundraising. There's also the climate tech.
Love it. CTVC.
Yeah, CTVC Climate Capital Stack, which we actually contributed to. Also, Daniel Criozeri has published this like series on the Climate Capital Stack. And so I think he highlights like 5 or 6 capital options that compare the different terms. I also would encourage folks there's a lot of like fractional CFO help that you can engage when you're making these decisions, right? And so if you don't have the personal experience to do it, there's lots of folks out there. And this is like, I'd encourage folks to go on, My Climate Journey, Work on Climate, whatever, on deck, and just be like, hey, I have these options. Can I pay someone, I don't know, for 10 hours of their time to like help me navigate this decision? And you'll get, I don't know, 50 people. They won't all be good. And so that's like the challenge, but you can ask them questions around like, how would you think about this thing as part of their interview? And you'll get a pretty quick sense of like whether or not they're dogmatic about a product or not, or whether you're actually approaching it sort of thoughtfully and holistically.
Amazing. Cool. So we've been dancing around what actually Enduring Planet does or what it is. So you did already give it like a 2-liner. Tell us more about what it is and how it fits into the landscape, and just, why debt financing, why you chose to work on debt financing, given the gap that you saw.
Yeah, so I'll focus on what we do, and I'll talk a little bit about the product that we publicly offer today, and then I'll tease our next product as well. And then we can talk a little bit about the role we think that these products play in the ecosystem and the value that they provide entrepreneurs. So we launched with a revenue-based financing offering. So revenue-based financing is meant for post-revenue climate tech companies. It can be, well, maybe I shouldn't say climate tech, any climate company, right? We serve small businesses, we serve startups. It really doesn't matter. As long as you have consistent growing revenue, with decent gross margins, we can probably write you a check. We publish all of our funding criteria for the revenue-based financing on our website. You can actually go look, you can decide if you're eligible. We also have a handy calculator on our website for folks to kind of estimate how much they'd raise. But process-wise, it's actually really simple. So it's a 10-minute application. Folks connect their financials through a secure API. We get them a term sheet in a week. We fund in a month. It's like probably the fastest capital you can get in the space today, except maybe some of the like crazy angels who like write checks after a half an hour meeting. But they're dilutive, we're not. So we fund without collateral or personal guarantees. It's like basically unsecured capital. And the way that it works is that we give you cash and you commit a portion of your revenue for a fixed term to us. And we really like this structure because what it allows companies to do is to pay based on their ability, right? So like you have a good month, you pay us more. You have a bad month, you pay us less. Unlike traditional debt, where you have a principal and interest payment typically every month, and if you don't pay it, you go into default and it triggers all sorts of conditions, which are often really painful for a business. They might like take possession of your IP. They might seize your personal assets, just like all sorts of stuff that can happen if you like borrow money on traditional terms that's secured. We also really like this instrument because it's easier to deploy and easier to manage and easier to underwrite. It's like very quick. It has sort of fairly basic underwriting criteria compared to, call it secured debt, where you might also have to underwrite assets, you might have to underwrite collateral, you might have to underwrite personal guarantee risk. Like there's all these other elements to traditional lending that you don't have to do for RBF. Now, it also means that like it's sort of it excludes companies that are pre-revenue, it excludes certain companies that have super lumpy revenue, it excludes companies where there's very tight margins. That's okay. We will lend to you later. We wanted to start with something that was fast and easy to deploy. It also lends itself really well to automation. And part of what we're trying to build is a platform that can deploy capital very quickly, which then requires automation. So we've signed 6 revenue-based financing transactions, about $1.5 million in loan volume. Our goal is to do 5 million at the latest by April of next year. I'm hoping we can do it sort of by the end of this year. I think we're on track to do that. And then we started piloting a second instrument, which I'm very excited about, which is an advance against state or federal grant funds that have been allocated but not dispersed. So for context, let's say you are applying for a California Energy Commission grant. They do like close to 10 billion a year of grant making in the space, and similar like DOE, USDA, you name it. You apply for a grant, and a public notice of award comes out. It's really exciting. They're like, hey, we've selected you. You're going to get $2 million. It's awesome. Well, if you think you're going to get that money soon, you're wrong. It's usually like anywhere from 3 to 12 months before you actually get any money in the bank. And that's true for both like upfront grants and cooperative agreements where there's like reimbursements happening in real time. And so in our case, we will lend to companies against that future grant funding, basically immediately after the public notice is released. And so we've done 2 of those deals. We'll do many more of them. We'll launch that product soon. Very excited about it. And over time, we'll expand to other instruments. So we've looked at lots of different like climate-specific credit products that we think fill desperate needs for businesses across the space. And so, keep an eye out.
Yeah, watch this space, as the kids say. No, I love it. So it's super fast, can be automated. You're making grants more attractive. Like I think that you're helping founders diversify the kind of money that they can take that hopefully is actually less expensive, right? Going back to that, or at least the right type of expense for those things.
So I think this is the point, right? Like sometimes our capital is, like RBF is not cheap. Mm-hmm. And that's okay. It's not meant to be cheap. It's cheap compared to its competitors, but it's not cheap debt. Cheap debt is usually secured and collateralized and personal guaranteed, or it's coming from like a concessionary source where they're not commercially lending, right? Like sometimes we will be working with a prospective customer, and they'll come back to us and they say, hey, like one of our existing investors is willing to give us debt at 5%. And I'm like, cool, take it. Like, I'm not going to compete with that. I'm not one of your existing investors. They get value in other ways. And so like, they're okay not making money on the loan, right? But what our capital is we think an incredibly founder-friendly product that allows folks to invest in their growth without giving up ownership of their business. And like apples to apples compared to other products that they have available to them is inexpensive. It is inclusive. It is not based on like where you went to college or like where you worked before. Like, we don't care if you worked at Facebook or Fuddruckers. If you've got a successful climate business that's growing and doing good work in the space, like, we'll back you. We don't care, right? We don't need $1 billion exit in 10 years. We're not equity investors. And so it allows us to go much broader. Like we did a deal with a compost company. That's awesome. Just awesome. And you can read case studies on our website. Like we publish all of them. We did a deal with a compost company. We did a deal with a SaaS company. One's venture backed, the other one's not. And like, yeah, maybe the compost company will raise some venture dollars eventually, but they're very dramatically different businesses, and that's okay. It still works for us and it works for them, and they like can take that money and put it to work immediately. So yeah, that's what we do.
Amazing. I love that. And you started to answer the question of like, who is best suited for all those questions. One other thing I want to throw out there is that you're always good at connecting founders to other sources of income or other sources of funding. So if they're not right for you, you have a bunch of VCs that you can give them to. You can say, take this other piece. Like you can actually, you feel very founder friendly, and obviously I like you as a person, but I just want to put that out there. If everything goes well and Enduring Planet is like achieves the dreams that you were hoping for, what's actually different about the world? And like, what's that vision for the world that you see with the vision of Enduring Planet?
I think that if we're successful, the true impact is not actually direct from us. Like, look, even if we do, I don't know, $10 billion worth of lending in the next 5 years, which would be wild, just like that's like 5x what we aggressively think we can do. 10 billion in 5 years is like infinitesimally small compared to the amount of money that we need in the market. But if we're successful, there will be 50 other players like us, right? And those 50 players will start to develop other capital instruments, right? And what I'm excited about is that founders can come into this space and build from like nothing to baller and have the right money available to them at any step or stage, right? You need project finance, cool, you can get it. You need asset finance, you can get it. You need this type of credit, you can get it. You need angel investors at this time, you can get it. And it's like efficient, because the problem is that by design, a lot of capital markets are not efficient. They have a lot of friction in them, which in most circumstances is fine. Like, does it really matter if the next like cat SaaS product gets funded tomorrow or in 6 months? But when the world's on fire, there's no time. Like, the opportunity cost of talented entrepreneurs not getting capital is that we're all fucked. And so what we need is a almost like a totally dramatically different capital market for climate that has some urgency in it. And that's what we're trying to like support. Is like, how do we, I don't get paid for making founder intros to VCs. I think I made like 100 last month. And most of those folks raise money from at least one of those intros. And so like, if I got to shorten their fundraising timeline by 2 weeks, like that's awesome. And we actually built an automated tool to make founder VC intros, because I'm like spending too much time on it. And so I think over the long term, my goal is that we can build a community collectively. Like we share deal flow with other lenders. We share deal flow with over 200 VCs now. Like, I want all of us to come together and be like, cool, let's all do better. Let's all move faster. Let's all support more underrepresented founders. Let's like actually put money to work on a timeline that makes sense. Because if we don't, we're screwed. It won't matter. Like, it won't matter how much money you made on that IPO. It will all be dead. And I'm not trying to put that out there like a doom and gloom thing. The people who like are approaching the climate crisis as anything but like dramatically disruptive are delusional. Right now, our job is to like minimize damage. It's not to avoid it. There's no avoidance anymore. But what we can do is we can do a lot to stop it from being really bad. And so like everybody here should feel excited for the challenge ahead. Like the thing that gives me hope is that there's so many talented people and so much like interest in survival, which makes sense because like pretty important.
Cool. I'm going to do rapid fire because we're going to go to audience questions real quick. But what is one gap in the climate finance space that you're not working on that you want someone else to work on?
Oh my God, there's so many.
You can rapidly just say them if that's quicker.
I think like super early project finance is really important. And I think super early asset finance is important. Now, on the asset side, there are folks doing really good work. Lacey's doing good work there. Third Sphere is doing really good work there. But it's like compared to the total volume of need, it's pretty low. Another one that is super cool is financing for other people to do decarbonization. So like rather than lending to the businesses providing the stuff, is lending to the buyers, right? You are, I don't know, let's say you're a supermarket and you want to go to heat pumps and solar, good luck finding money for that. And so somebody providing that kind of capital, it's like approaching it from the buy side rather than supply side, super impactful.
Amazing. And you know, I'm working on the first of a kind project finance. It's my where I'm heading. Okay, another rapid fire. What advice would you give entrepreneurs who are looking to start a company in the climate finance space? So you already gave them a lot of advice about, you know, understanding the terms of different sort of finance classes. But if they actually want to start a company in a space, what advice would you give them rapid fire?
Make sure you have a finance person with you doing it. I think like I'm a finance enthusiast, but when I started my business, I went to my now co-founder, Erin, who raised close to $200 million for her last debt fund in cleantech. And I was like, hey, I need a debt person and you're awesome. So come build this thing with me. Just make sure, like, approach it not just like as a climate tech business that's like, oh, we're going to do finance. Like, really make sure you have the talent because there's enough complexity and nuance so you can like really screw things up if you don't have that in-house.
Very smart. And good choice on Erin. Okay, great. So we've got a bunch of awesome questions in Slido. You're welcome to add more questions if you have them. So, and a quick shout out, Denise knows I do this all the time. I have something called Crisp working in the background, I think, that is hopefully getting rid of background noise. If it isn't, then maybe you can hear the background, but it's KRISP. It's like life-changing when we're on Zoom all the time. Hopefully it's on. Great, I'm glad it's working. But that's my pitch that I give every day. So first question, Dimitry, you recommended the importance of founders educating themselves on all the different climate tech funding options. How can they actually educate themselves?
Oh man, go to workshops like this, read the sort of like climate capital stack pieces that have been put out, read our insights series. There's other folks who run podcasts on this space. I'm gonna like obviously blank on all of them right now because that's what happens when you make statements like that. But there's starting to be more and more resources on it. I'm pleasantly surprised by the volume of good content on Twitter also. And then I think, you know, it doesn't have to be climate specific, right? Like there's a lot of pieces that have been written on venture debt, on revenue-based financing, on inventory finance, on alternative credit. Like I would probably start by getting sort of terminology and then go bigger, right? So if you're like, oh, I do, I don't know, EV leasing as my business, cool. Like you are probably eligible for asset finance or asset-backed finance or receivables finance, project finance. So like those are the places to look. But you also might be able to access other corporate credit instruments to allow you to like market your product, revenue-based financing, whatever. And so I think if you're struggling to get educated, like pull in experts. There's a lot of folks that provide advice in the space who you can follow on Twitter or LinkedIn. Unfortunately, there's not like go to like climatefinance.com. You're not going to find that yet. Maybe we should build that. But there's starting to be more and more content around this.
Amazing. Thank you for that. So I'm going to combine two quick questions, which is, could your venture debt model work for a climate nonprofit? And there's one about, do you have diversity metrics that you're hoping to achieve? So those are maybe two separate questions, but.
I can answer both of them.
Yeah,
no,
great.
We don't lend to nonprofits, but we also don't do venture debt. So I want to be very careful. Like venture debt is a very specific instrument and people should be very careful when they talk about it. It is debt for venture capital backed businesses that is often lending against them raising another venture round. It is available to like 1% of VC backed companies and typically follows like very prominent investors and has dilutive principles. So no, we can't lend to nonprofits yet. We might. I think the grant advance would actually work really well for nonprofits because often bridging that gap from grant to not grant is like really important. But we don't serve nonprofits today. Thank you for suggesting that though. And yes, we do have diversity, equity, and inclusion criteria for our lending. So we prioritize lending to underrepresented founders and diverse teams. We have usually 3 metrics we look for. They're sort of inspired by a firm called K4 Capital. So it's either, are the founders underrepresented? Is the team at least 50% diverse? Or is the company serving marginalized communities? Those like, if a company meets one of those 3, we're really happy. It's not a hard requirement for us, but I think right now our entire portfolio meets those criteria and like 80% of our pipeline does. And so we're pretty happy with how we're like ticking DEI boxes. I think that's like a complicated thing to think about. And there's a lot of like evolving thinking about inclusion in capital markets. But we're trying, and it's actually part of our corporate DNA. So we're a Delaware Public Benefit Corporation, and like supporting underrepresented founders and diverse teams is part of our corporate mission.
Amazing. Cool. Thank you. Does the source of revenue influence your decision to provide capital? Does it matter if the revenue source is carbon credits or carbon offsets? I'm guessing there's some, yeah, you take that. I get why they're asking that.
So I think for us, and this is specific for the revenue-based financing product, right? So like we'll have other instruments that will be more comfortable with all sorts of different sources of revenue. But for revenue-based financing, the key is that the revenue is consistent and predictable. It does not have to be recurring. So we believe that a business that has historically grown 50+% year over year selling hardware and is like selling to a specific customer class where there's probably lots of unmet demand, we think that's predictable. Now, if you are doing nature-based solution credits and you like sold your first batch to Stripe and you had revenue like 1 month out of the year last year, like probably not predictable. And so the thing is, like, I don't think that should stop you from applying. You should still apply. And then we can start to build a relationship and provide you capital when it is more predictable or when we launch an instrument that works for you. It's a 10-minute application. So it's like no cost off, no skin off your back.
Question from Jackson. How are really large renewable energy projects like large solar farms typically funded?
Oh man. So the project finance landscape is like totally different. There's usually project equity, project debt. There's also like corporate finance work that has to happen where the developer itself will raise some money and they'll use that money to like start the project and then they'll raise money into the project. But generally what happens is that people will raise capital, both equity and debt, into an off-balance sheet facility. I'm going to use a bunch of terms here that like I don't have time to define, but and those folks are investing just in the returns that project will generate on an individual basis. And so they're like usually investing with very different return and risk expectations. They can take possession of the project if stuff goes wrong. It's often very complex, and it takes a while. I'm going to stop there. Happy to give more answers, but there's on project finance and renewables, there's like gigatons of content to learn.
Yeah, and it takes like, I think it's like $1 to $3 million in just lawyer fees to get one of those things.
Yeah, it depends on the size of the project. I mean, I think there's some really innovative work that's happened, especially in emerging markets around small project finance and renewables, where people will bundle projects. I actually wrote my master's thesis on this. So like, there are like lots of different fun things you can do to make those projects work, but it's like a totally different animal than like the corporate finance world that we play in.
Mm-hmm. So which debt financing products are actually accessible to climate entrepreneurs today? And what products do you hope to make accessible in the future?
The answer to the second one is all of them. The answer to the first one is it kind of depends, right? So it depends on your stage and where you're at. If you are post profitability doing, I don't know, 10, 15, 20 million plus of revenue a year, you can access all sorts of credit, bank debt, lines of credit, whatever. If you are backed by really awesome VCs, like top 5% VCs, you can probably access venture debt. If you are not either of those things, the options are somewhat limited. So in some cases, you can get loans from private wealth, like from private foundations. Those are really hard and like super relationship driven. We just did a piece on this, like raising money from private foundations. There is LACI. So the Los Angeles Cleantech Incubator has a credit fund. It's on the smaller side, they do smaller checks. And I think right now it's still restricted to members of accelerators in the like LACI partner network, but that I think will change. Third Sphere offers generally like asset-backed lending. Although I think they're starting to expand it to other credit instruments. They have like a $100 million credit fund. There's a group called Homecoming out of the Bay, which does like boutique lending and investing in climate, generally larger tickets. And then there's us. And that's basically it for corporate debt options in the market. Now, there are folks who are not specialists in climate. So you can access, I don't know, factoring from Pipe or TapChase. So that's like, if you're a SaaS business, you can sort of pre-sell your SaaS contract. If you're in e-commerce, you can get, Clearbank, Stripe, Shopify has capital options. They all are kind of priced the same and are structured kind of the same. And frankly, if you're going to access one of those, you should just take money from us because we like give you way more than just the capital and like they don't give a shit about you. That's kind of it. I mean, there's like, yeah, that's basically it.
Amazing. Cool. Thanks we're running through these. We have 11 questions left. I don't think we'll get to all, but we're actually making progress. How do you ensure that the revenue the company generates gets through the waterfall and paid back to you? Do you ask them to open escrow?
Yeah, so the way that we work is we connect in real time to folks' bank accounts and accounting products through an API. So it's like 2 steps through Plaid basically for bank, and we connect directly to QuickBooks, Zoho, Xero, like a bunch, all the main accounting tools. And so we track your performance in real time. And then at the start of every month, we review all of the gross cash receipts coming into the business the previous month, and we actually ACH debit our funds. And then we send an invoice to the company. And then if like there's any discrepancies we discuss, we send money back. Super easy. What it means is that you don't have to do any accounting to like figure out how much you have to pay us. We decide what you pay us. And like, it's up to you to dispute if you want to dispute, but obviously it's not in our best interest to like mess around with how much money we take. We want to be very specific about like drawing the right amount. There's no escrow, there's no like complicated stuff. And we also, if companies need help figuring out like tax and accounting questions around our product, we actually provide a memo from our tax firm, which is like top 3 in the country. And we just say, hey, here's the guidance. And like, you can use your bookkeeper to do whatever you want.
Amazing. Cool. I'm going to bring these two questions together again. So one is it's essentially asking you to walk us through what like a term sheet could look like on your side. So given a good proposal, what's the typical variance in terms of, in terms one would expect, how much shopping around should one do, to just past necessity or to exhaustion? So that'll be part one of this question.
So our term sheet's actually public on our website. So you can go and see all the terms if you want. It won't tell you how much you're going to raise, right? Because that's dependent on how much revenue you have, how much growth you've done historically, and like how we think about your future growth. I would say like we have this calculator where you can estimate like a 2-year RBF in 10 seconds based on your monthly revenue and your monthly growth rate. It's not going to be 100% accurate, but like it'll give you a ballpark of where you get to. Generally, we lend against somewhere between 1 and 10% of rev share, and between 1 and 2 year terms, and somewhere between 100 and 500 grand. We can actually go above 500 because we can tranche funding. So we can basically pre-commit to injecting additional financing once certain conditions are met. So we've like written 700, 800K term sheets where we're deploying funding over a 6, 9, 12-month period. It's harder for me to like, it's impossible for me to say like, oh, you should expect these terms because it's really dependent on your revenue. But the cool thing is we make it really effortless. So if you apply for funding and connect your financials, like we might ask you to send us 2 or 3 more documents. And then generally we don't need to do, unless there's something weird about your business, there's no additional diligence we need to do to get you a term sheet. And so like, if you want, and it's what's the word I'm looking for? It's non-committal. That's not the word. Anyway, we send you a term sheet. You don't have, like, even if you sign it, you don't have to go through with the financing. And it's non-exclusive. So we're not in the business of screwing over founders. We want to give people non-binding. Thank you, Nisha. It even says it on our website. I just couldn't think of the word. So like we make it really effortless for founders to raise capital from us.
Excellent. So this is part 2. I don't know if it actually is answer this however you want. For Matthew, it says, could you give an example of a debt product that's not project finance or venture debt? What stage of development does it best apply to? What's the cost of it? The track record required, default rate? Big question potentially, but how would you answer that?
So revenue-based financing is an example, right? So like typically what you need is somewhere between 250 to 500 grand in trailing 12-month revenue. So you need some revenue track record. You generally need to see some growth. So like over 30% year over year, but you could go lower. It just like affects. So like, because revenue-based financing is based on your future revenue and how they project your future revenue, your past performance is kind of an indicator and it drives that model, right? Generally, revenue-based financing, depending on how it's structured, has a target IRR of anywhere between 15 to 50%. Has to do with the risk in your specific business model, has to do with the term. Like if, for example, ClearBank financing for e-commerce businesses is a form of RBF, it runs between 6 to 12% in the fee that they charge you, but it's anywhere from like 2 to 6 months. So if you're paying 12% over 3 months, your actual cost of capital is closer to 50. Okay. And it's generally depends on your historical financials, right? But the cool thing with revenue-based financing is it's unsecured. So if your business is doing 1 million in revenue today and it goes to 0 revenue tomorrow, that's it. They're not going to like come after your house. They're not going to come after your assets. They're not going to show up at your office and take your laptop. Like that's part of why it's more expensive than, let's say, a term loan from a bank, but that bank will do all of those things. And so, other products include like inventory finance, usually an early stage climate business. There's a bunch of like boutique alternative credit options for inventory finance. It's somewhere in the like mid to high teens. It's secured against your inventory, usually like 3 to 6 month terms. I don't know, there's lots of products. the work that Danielle Cruzeri is doing, I think, includes some of those indicative terms. And I think the CTVC piece also mentions some of those targets. Often lenders in the space are very cagey about their cost of capital. We're not, but other folks are.
Amazing. Okay, I think that's the last question that we could fit in. Someone was curious about the companies that you funded and how we could find them. I think in general, how can people find out more about you, your work? You can drop some things now, and I'll send out an email with the recording with some links. But yeah, Dimitry, how can people be in touch?
So enduringplanet.com, you can apply there, 10 minutes if you want funding. You can also shoot us an email, I think contact@enduringplanet.com. You can also send it to really any email address, we'll get it. We have an insights series. So that's where we post these tactical pieces around sort of climate, entrepreneurship, and capital. We have case studies on the website that show at least the ones that we're comfortable speaking about right now. We're publishing them probably on a 2 to 4 week cycle. So it's a little behind. Twitter. Nice. We do a lot on Twitter, LinkedIn. Please follow us on Twitter. The more followers we have, the happier we are. At enduring_planet.
Hell yeah. Amazing. Thank you, Dimitry. Thank you, everyone, for being here, engaging, asking questions. I had a ton of fun talking about climate finance with you. Yes. What other one?
And then the last thing, I'm going to put my email in the chat. And if you have a question I didn't answer, feel free to email me.
I love that. I think there are definitely questions that we didn't get to and questions in the chat as well. So email Dimitry. He's the best. Super helpful. Thank you.
Thank you.
Yeah. All right. We'll see you all. Bye.
Cheers.